Hello, everybody. In this short video, what we're going to talk about is when not to trade. Recognizing market conditions that will reduce your edge, even if you have the best strategy on the planet. There's times, as we've covered in another video, that perhaps the market condition doesn't suit your strategy. So a sit on your hands approach is the right way to go. We've got two key decisions to make when trading: deciding when to enter and deciding when not to trade at all. There's two key layers of risk control that we can employ. The first of these is what we term invalidation. We've done other videos on this, which is managing trades that stop working. So you're actually already in the trade and market conditions change. Perhaps the price action that you originally identified doesn't come to pass and we get a reversal. So invalidation is all about managing bad trades once you're in it. However, what we're focusing on today is selectivity. So avoiding poor market environments, preventing bad trades in the first place. So invalidation manages bad trades, selectivity prevents them. And it's a combination of these two which tend to produce better results if we master them. So just briefly on invalidation, just to refresh, things that may indicate that we should no longer stay in a trade may include structure breaking the wrong way. So, for example, entered on a break of a resistance, price moves back into the range it's just broken out on. P levels failing and momentum fading or reversing. And we've talked again about this when we talked about exits. Perhaps a MACD signal line crossing over the histogram when you're in a long trade is a sign that momentum is failing and it's maybe time to exit a trade. But this is a different type of discipline we're talking about today. So not should I exit this trade, but should I even be trading here at all? Because many unnecessary losses occur because traders who are so keen to take advantage of market conditions enter markets that offer very little edge potential at all. So why is it so hard not to take the trade? Walking away is a skill because it fights some deeply wired instincts that are part of us as humans. The first and very common characteristic is that we have a fear that the move will run without you. So fear of missing out means that we enter a trade that we perhaps shouldn't, just in case it should be the next winner. There's many biases associated with trading, and one of these is termed action bias. This is when it feels flat by doing nothing. So we feel as though we have to be active as traders, but we're failing to recognize that being active includes making an active decision not to trade because the market setup isn't as it should be. We've got this sunk cause effect where you've done the analysis, so you should trade it. So you spent a long time looking at this stock. Finally, it's broken out of a range and you've been watching it for so long that you think, right now, I've got to get in it. Failing to recognize, of course, that in the fairly recent history, perhaps there's another level just a little bit above where you've entered that could be a potential reversal point. So what tends to happen is we get a confirmation bias in that we just look for things which support the trade rather than recognizing things that might not support the trade with a potential edge. And of course, there's no scoreboard. We don't get a figure in our profit and loss column if we don't trade. I remember in my early days of trading, I adopted the approach that every dollar had to be working in the market all of the time. And I donated to the market regularly because of that particular attitude. It took a long time to unwire that particular habit. So the bottom line conflict is internally your brain rewards activity. I'm doing something, I'm thinking about something, I'm analyzing something, and that's a good thing. Whereas your actual trading account rewards selectivity in terms of whether you sit on your hands or whether you take action on a trade. Many traders feel the pressure, as I've already indicated, to always be active. But the edge is really not to trade more. The goal is to trade when conditions are favorable. That's the professional mindset. And sometimes the most profitable decision is simply waiting for the right trade to come along. And remember, as we covered in a previous video within this series, strategy versus market type is critical. So when you decide not to trade, I want you to really lock in that make waiting and active skill is your goal. Sitting on your hands is a decision. Record it like one. So actually physically record. We have an actual indicator that we have that records trades that you chose not to take. But log it in a journal. Name the condition that stopped you, mark the chart and set an alert, then step away. And then what we can do is we can look at all of the trades that we didn't take to see if your selectivity actually paid off or not. Another way of looking at this is that a correctly avoided trade is a win. It just never appears in your profit loss. So the key message from this is it is an active decision not to trade. It's not passive. So let's look at 4 market conditions that reduce edge and the probability of success. The choppy or overlapping price action, pre-event uncertainty. For example, if we've got a big data point coming out, late stage extended trends, where the trend that you've jumped on is already very well established. We've all seen occasions when we've done that and then only to see that the next few candles we see a reversal. And markets sitting in the middle of ranges. In these conditions, the market often lacks clear directional behavior, and that's a key point to have as part of your pre-trade checklist. We talked a little bit about this when we looked at strategy versus market conditions, of course. So this overlapping price action is one of the clearest warning signs. So if we get frequent reversals, i.e. a couple of candles that go to the upside and then a couple that go to the downside, then upside, downside. So that's really one of the key signs that perhaps we need to sit on our hands. Candles overlapping previous candles, so failing to suggest that either the buyers or sellers are in control. Breakouts failing quickly. So if we get successive breakouts which have subsequently been fake outs and move back into ranges, that's an indication that perhaps that resistance, because it is called resistance for a reason, of course, is one that the markets need some significant evidence to break through. So in that case, perhaps waiting for not only the breakout candle, but the one next to it. And then lack of sustained momentum, of course. If we are trend traders, and many of you are, then momentum is a key thing to keep an eye on. And if we get histogram on a MACD that aren't moving higher and higher and higher, then that's a sign that momentum isn't strong enough, perhaps, to sustain a move. These environments all tend to produce noise rather than trends ultimately. Pre-events uncertainty markets often are unstable ahead of major events. We all know this, and it is somewhat dependent on not only the event but the context in which it sits. Clearly, there are some major events such as CPI releases, central bank announcements, major earnings if we're trading stocks, and geopolitical developments which may be brewing. Ahead of these events, we often get a drift sideways, we get false breakouts, and we get sudden volatility spikes not only when it happens, but also perhaps just before it happens as markets reposition. So it's worthwhile keeping an eye on what events are due, making a decision on, is this a potential danger to the trade that I'm thinking of entering? And so waiting for post-event clarity is often the higher probability approach. This may seem like common sense, but often we fail to follow through on common sense in the heat of the market. Late stage trend moves we've talked about before. Most of the move has already occurred. Momentum begins to slow. We see profit taking, and then a consolidation or reversal develops. So look for extended moves away from structures as a potential warning sign. So if a trend is already 4, 5, 6 candles into its trend, perhaps it's already too late. We may see increased volatility as markets reposition, and we get slower follow through. Perhaps those candles are getting smaller and smaller, suggesting that the buyers aren't quite as compelled as they were in the early stage of a trend. The middle of the range problem is worth referencing. We've got a low probability zone. To be really prudent, not only in terms of looking for potential moves, but look for longer term resistance and support. If a price is in the center of a range, even if it's some distance away from a key support and resistance, then without a clear catalyst, it's unlikely to push through those levels. It's one of the reasons why looking at higher time frames is possibly worth including in your trading plan. So higher probability trades will invariably occur near structural levels. So just to start to wrap this up, I thought it would be useful to give you a practical, simple pre-trade checklist. So before entering a trade, ask these questions. Is the market structure clear? Is price behavior clean? Is there a clear location for the trade? Not only right now, but also where it might go to. For example, looking at proximity of the next key level, as I've already referenced. Am I avoiding obvious uncertainty, for example, an impending data point? And am I entering after the move has already happened? We see this time and time again because it's FOMO kicking in. We don't want to miss out. Oh, if we don't get in now, there's potentially more in this move that I'm seeing on my chart. Adhere to those 5 clear, simple pre-trade checks, and that will serve you well. And if any of these are unclear or observed, question the wisdom of the trade you're thinking of entering. And of course, as I said before, if you record these, it'll provide the evidence to guide you in future trades. And just to reiterate the key message, make waiting an active skill, log it, mark the chart set alert, and then have a look at whether your selectivity paid. If it did, that's the evidence you need to do the same thing again. Remember, a correctly avoided trade is a win. That's it for today. I hope that's been useful. Just reinforced a few really important messages. And as always, trade safe. We look forward to seeing you next time. Bye bye for now.